Millions of people celebrate the day they finally close on a house. They have no idea they just activated a hidden, century-old financial mechanism designed to quietly extract their lifetime wealth. The pen scratches against the thick, legal paper. It is 10:15 a.m. on a Tuesday in a sterile title company office in suburban Dallas. Sitting at the mahogany table is a 32-year-old man. He is exhausted. He is deeply in debt. But as he signs his name on the final page of the closing documents, he feels a profound, almost intoxicating sense of relief. He has just purchased a home. He has just done what society, his parents, and every financial spreadsheet told him to do. He has stepped off the treadmill of renting. He believes he has just secured his financial future. He looks at the keys on the table and he sees wealth. He sees a guaranteed investment. But if he knew what he had actually just signed, the relief would vanish. We are taught a very specific religion in the modern world. We are told that real estate is the ultimate infallible engine of human wealth. You buy a house, you pay down the mortgage, the line goes up, and you become rich. It is the American dream. It is the global standard of financial competence. But there is a deeply uncomfortable flaw in this narrative. It contradicts over a century of actual economic data. To understand the illusion, you have to look at the work of Nobel laureate Robert Shiller. Shiller did something that very few financial analysts ever bother to do. He stopped looking at 5-year trends. He stopped looking at regional boomtowns. He went back to the year 1890 and he tracked the real inflation-adjusted return on United States housing for an entire century. 100 years of data, through world wars, depressions, and economic booms. His findings were completely devastating to the modern financial narrative. Over that 100-year period, from 1890 to 1990, the real inflation-adjusted return on a house was virtually 0%.
Zero. Housing showed a relentless, historical tendency to simply return to its exact 1890 baseline in real purchasing power. The price of the house went up over time, yes, but the value of the money went down at the exact same rate. The massive wealth generation that people believed they were experiencing was mostly just an illusion of nominal inflation. But it gets worse, because a house is not a stock. A stock is a piece of paper. A stock sits in a digital vault and costs you nothing to maintain. A house is a physical object, and the physical world is governed by entropy. Macroeconomists, operating on Franco Modigliani's Nobel-winning life cycle hypothesis, do not view a house as an investment vehicle. They view it as a consumption good. The dirt underneath the house might appreciate, but the structure itself is in a constant, relentless state of physical decay. The roof rots, the foundation settles, the pipes rust, the HVAC system dies. Every single year, the physical structure demands capital expenditure just to remain habitable. You are pouring money into a decaying asset simply to maintain its baseline value. Treating a decaying consumption good as your primary wealth-building vehicle is mathematically flawed. It is like buying a massive, expensive machine that slowly eats its own parts and convincing yourself it is a savings account. So why does it feel like it works? Why are there millions of millionaires who built their entire net worth on real estate? Because the system is rigged, but not in the way you think. The air inside the accountant's office is cold, smelling of stale coffee and laser printer toner. It is mid-April. A married couple sits across from a tax professional. They have just sold the home they lived in for the last 10 years. They bought it for $300,000. They sold it for $800,000.
They made $500,000 in pure profit. In any other financial market, the government would be waiting at the door. If they had made $500,000 trading stocks, selling a business, or liquidating a gold portfolio, the Internal Revenue Service would immediately demand a massive percentage in capital gains taxes. The accountant taps a few keys on his keyboard. He looks up. He tells them they owe absolutely nothing. $0 in taxes. This is the hidden architecture that makes housing feel like a miracle. When financial creators compare paying off a mortgage to investing in the stock market, they always run the math on compounding interest. but they almost never factor in the single greatest legal loophole in the United States tax code, IRS Section 121. If you sell a primary residence that you have lived in for just 2 of the last 5 years, up to $500,000 of the profit for a married couple is completely, entirely tax-free. No stock portfolio on earth has this level of exemption. The government is essentially handing you $500,000 in untaxed, invisible income. But the subsidies go much deeper than that. They reach into the very definition of how we measure income. Economists recognize a concept called imputed rent. If you own a house and rent it out to a stranger, you collect money every month. The government taxes that money as income. But if you live in the house yourself, you are economically playing both roles. You are the landlord and you are the tenant. You are effectively paying rent to yourself. You are receiving a monthly dividend in the form of shelter. In countries like Switzerland or the Netherlands, the government actually taxes this. They look at the rental value of your home and they tax you on the imputed rent you are paying yourself. But in the United States, this massive invisible dividend is completely untaxed. This structural loophole makes a paid-off house wildly more advantageous than a dividend-paying index fund of the exact same value.
And then there is the most famous subsidy of all, the mortgage interest deduction. We are told that the government intentionally designed this deduction to incentivize homeownership, to help the working class build their dreams. That is a lie. When the federal income tax was created in 1913, all consumer interest was tax deductible. If you took out a loan to buy a horse, a car, or a vacation, the interest was entirely deductible. It was just the standard way taxes worked. But in 1986, President Ronald Reagan pushed through a massive tax reform act. The government needed to close loopholes. They killed the deduction for credit cards. They killed it for auto loans. They killed it for personal lines of credit. The mortgage interest deduction survived, not because of a grand, noble vision for the middle class, but purely by political accident. The real estate lobbying power was simply too strong to fight at the time. The deduction was the sole survivor of a legislative massacre. The system was not built to make you rich. It just accidentally made it illegal for the government to take your housing wealth. But to understand why this entire game exists in the first place, you have to go back to the darkest days of the American economy. You have to look at the man who invented the cage. The winter of 1933 is bitterly cold. The streets of Washington, D.C. are quiet, covered in a thin layer of dirty snow. The mood inside the federal buildings is desperate. The United States banking system is suffocating. People are losing their homes by the thousands. But they aren't losing them because they made bad investments. They are losing them because of how mortgages used to work. Today, we take the 30-year fixed-rate mortgage for granted. We view it as a natural law of physics. But before 1933, the 30-year mortgage did not exist. It is a completely artificial product. In the 1920s, if you wanted to buy a house, you went to a bank and secured a balloon loan. The terms were brutal. You paid interest only, usually at 6 to 8%, for 3 to 5 years. At the end of that short term, the entire principal balance was due in one massive lump sum payment. If you couldn't pay it, you had to hope the bank would agree to refinance the loan for another 5 years. During a booming economy, it worked. The banks were happy to roll the debt over. But in the early 1930s, the Great Depression shattered the illusion. Banks ran out of money. When those 5-year balloon loans came due, the banks simply refused to refinance. They demanded the cash. The homeowners didn't have it. The foreclosures began. The crisis threatened to bring down the entire American financial system. Enter John H. Fahey. Fahey was a newspaper publisher from Boston. He was brought in to chair a newly created government entity called the Homeowners Loan Corporation, the HOLC. Fahey looked at the cascading failure of the banks, and he realized the 5-year balloon loan was a death trap. He needed a way to stretch the pain out. He needed a way to lower the monthly burden on the citizens so they would stop defaulting and save the banks from total collapse. Under Fahey's direction, the government bought 1 million failing mortgages from private banks. They bailed out the financial institutions. And then they fundamentally altered the debt.
They introduced long-term, fully amortizing loans. Originally set at 15 years, these loans slowly paid down the principal with every monthly payment. Eventually, this evolved into the 30-year standard we know today. The 30-year mortgage was never designed as a wealth-building engine for the middle class. It was designed as a shock absorber for the banking sector. It was a brilliant piece of psychological engineering. By stretching the debt out over 3 decades, the monthly payment became small enough that a working-class family could afford it. But the total interest paid over the life of the loan became astronomical. The 30-year mortgage is a machine that converts human labor into banking capital, slowly, invisibly, over the course of a lifetime. And because the monthly payment feels manageable, the prisoner happily paints the bars of their own cell. But eventually, people try to escape. They realize the interest is eating them alive, and they try to pay the debt off early. And that is when they discover the trap.
The tractor engine cuts out. The silence that follows is heavy, pressing down on the endless, flat expanse of the Iowa farmland. It is 1984. A 50-year-old farmer leans his head against the steering wheel. He is covered in dust. His hands are cracked. He is staring out at 1,000 acres of prime agricultural land. He owns it. He worked for decades, pouring every spare dollar of cash flow he had into paying off the mortgages on this land. He hates debt. He was raised to believe that debt is a sin. He was told that a paid-off property is the ultimate safety net. He did everything right. And next week, the bank is going to take it all away. During the 1970s agricultural boom, crop prices were sky high. Farmers made incredible profits, and thousands of them used that cash to aggressively pay down their land mortgages. They became equity rich. But in the early 1980s, the world changed. The Federal Reserve spiked interest rates to fight inflation. Commodity prices crashed. Suddenly, the farmers had no cash coming in. They couldn't pay for seed, they couldn't pay for equipment repairs, they couldn't pay their property taxes. They were sitting on millions of dollars of equity in the dirt beneath their boots. But equity cannot buy groceries. Equity cannot pay a tax bill. They were land rich and cash poor. Because they had locked all their liquidity inside the physical asset to avoid interest payments, they had no cash reserves to survive the economic winter. When they went to the banks to borrow against their land to survive, the banks refused. The local economy was crashing. The land was suddenly viewed as toxic collateral. Thousands of farmers who had massive equity lost their multi-generational farms to foreclosure simply because they had run out of liquid cash. This is the ultimate historical case study on the danger of prepaying debt. In 2019, a massive macroeconomic study was published, the Jorda Schulerick-Taylor Macro History Database. It was the most comprehensive analysis of asset returns ever conducted, tracking 16 advanced economies from 1870 to 2015. The study found something fascinating. On paper, over the long run, housing and equities produce similar aggregate returns. But housing carried a massive, dangerous, and often completely ignored hidden risk: the illiquidity premium. When you lock your wealth inside a paid-off physical property, you are destroying your capital mobility. You are tying your financial survival to a single, localized geographic point. If the main employer in your town goes bankrupt, if the local economy collapses, your property value drops. And worse, when you desperately need access to your locked-away wealth, nobody will buy the house, and no bank will lend against it. Standard finance creators tell you that paying off your mortgage guarantees safety. History proves that during a localized economic collapse, a paid-off mortgage is an anchor wrapped around your neck. It traps you exactly where the fire is burning. But the rules of this game are not the same for everyone. If you look closely at how the billionaire class handles real estate debt, you begin to see a completely different set of mathematics. The glass walls of the conference room overlook the sprawling skyline of Manhattan. It is 2 p.m. A commercial real estate developer is sitting across from a team of institutional lenders. He has a very simple request. He owns a commercial skyscraper. He has a $100 million mortgage on the building at a 6% interest rate. He has a massive pile of cash, and he wants to pay the loan off early. He wants to be debt-free. The lead banker smiles, adjusts his tie, and nods. Certainly, the banker says, you can pay off the principal today, but the penalty fee will be $12 million. The developer does not argue. He knows this is how the real game is played.
In the United States, if you have a standard residential mortgage on a single-family home, you can usually pay it off early without any penalty. Laws like the Dodd-Frank Act severely restrict prepayment penalties for consumers. The government structurally subsidizes your ability to escape the debt. But in the world of commercial real estate, the rules of gravity change.
Commercial lenders do not view a mortgage as a loan. They view it as a guaranteed fixed-income bond. They expect a specific yield over a specific period of time. If a billionaire developer tries to pay the loan off early, they are disrupting the bank's mathematical models. To prevent this, commercial mortgages include a brutal mechanism called yield maintenance, or sometimes defeasance. If you want to pay the debt early, you must pay a massive mathematical penalty to guarantee that the lender receives the exact amount of interest they would have made if you had carried the loan to term. The wealthy are actively penalized for trying to escape debt. They are forced to operate in a system where leverage is permanent, and yet they thrive because they understand that holding standard fixed-rate debt on an inflating asset is the closest thing to magic in the financial world. To understand just how powerful this magic is, you only have to look at what happened when the banks tried to take it away from them, the middle class. In the early 1980s, inflation was tearing the American economy apart. Mortgage interest rates hit 15, 16, 17%. Nobody could afford to buy a house. The banks were desperate to originate new loans, but the consumer was tapped out. So the banks invented a new product, the shared appreciation mortgage, the SAM. The pitch was brilliant in its deception. The bank would offer you a deeply subsidized, below-market interest rate. Your monthly payment would be incredibly low. You could finally afford the house. But in exchange, you had to sign a contract agreeing that when you eventually sold the house, the bank would take 30 to 50% of all the equity growth. It was a disaster. The product failed spectacularly because borrowers quickly realized the horrific truth. Trading away the future equity of an inflating asset in exchange for short-term cash flow completely gutted their long-term net worth. The shared appreciation mortgage revealed the quiet superpower of the standard 30-year loan. With a standard mortgage, the bank takes the risk of inflation, and the borrower keeps 100% of the asset's appreciation. The banks realized they were losing the game. The fixed-rate mortgage was suffocating them. They were locked into receiving 5% interest from loans written in the 1960s, while inflation was raging at 15%. The banks were bleeding out. They needed a way to transfer the risk of inflation back to the human being. In 1982, the government stepped in to save them again. They passed the Garnes-Saint Germain Depository Institutions Act, a sweeping piece of deregulation. Hidden inside this act was a provision that preempted state laws restricting alternative mortgages. It opened the floodgates for the adjustable rate mortgage, the ARM. The bank was no longer trapped. If interest rates went up, your monthly payment went up. The risk was transferred from the institution to the family. But the banks couldn't help themselves. They took this new freedom and they pushed it to its absolute psychotic limit. In the mid-2000s, leading up to the great financial crisis, lenders like Countrywide and Washington Mutual introduced the most toxic financial product ever sold to the public, the option arm, the pick-a-pay mortgage. Every month, the borrower received a bill with choices. You could pay the full principal and interest, you could pay just the interest, or, terrifyingly, you could pay a minimum amount that was less than the interest owed. If you chose the minimum payment, the unpaid interest didn't just disappear, it was added to your principal balance. This was called negative amortization. You were making a payment every single month, and every single month you owed the bank more money than you did the month before. The debt was a living thing, feeding on the house, growing larger in the dark.
It was the ultimate anti-payoff product. It was a major catalyst for the subprime meltdown. The system had engineered a way to ensure that the debt could literally never die. And if you think that sounds like a dystopian nightmare, you only need to look at what happens when a housing market completely detaches from reality. The neon lights of the Ginza district reflect in the puddles on the Tokyo pavement. It is 1989. The Japanese asset bubble is at its absolute euphoric peak. Real estate prices are moving at a speed that defies human logic.
The grounds of the Imperial Palace in Tokyo are theoretically worth more than all the real estate in California combined. Inside a sleek, minimalist bank office, a young salaryman is sitting with his pregnant wife. They want to buy a small, unremarkable apartment. The price is astronomical. It is mathematically impossible for them to pay off the loan in their lifetimes, even if they give the bank every single yen they earn. The loan officer smiles. He slides a specialized contract across the desk. It is a 100-year mortgage. During the late 1980s, the Japanese housing loan corporations, the Jusen, created intergenerational debt. The asset prices were so high that the only way to maintain the illusion of affordability was to stretch the amortization schedule across multiple human lifespans. The salaryman signed the paper. He agreed to take on a debt that he would pay for the rest of his life. And then, upon his death, the remaining balance would transfer to the unborn child sitting in his wife's stomach. They were collateralizing the labor of people who had not yet been born. When the bubble burst in the 1990s, the prices of the apartments collapsed, but the debt remained. Families were trapped in negative equity for generations. The psychological damage, the destruction of lifetime utility was incalculable. We look back at 1980s Japan and we think it is a historical anomaly, a bizarre moment of collective insanity. We are wrong. Fast forward to Sweden in 2013. The Swedish housing market was booming. Interest rates were incredibly low, but housing prices were rising far faster than wages. Swedish banks realized that forcing people to pay down the principal was slowing the market down, so they essentially stopped requiring it.
They allowed borrowers to pay only the interest, endlessly. Mortgages became permanent subscriptions to the property. When Swedish regulators finally audited the system, they discovered something terrifying. The average amortization period for a Swedish mortgage had reached 140 years. Generations of Swedes were simply treating their homes like rental properties owned by the bank, passing cheap, unpayable debt from parent to child. The government panicked. They realized the entire country was drifting into permanent servitude to the banking sector. In 2016, the Swedish government was forced to legally intervene. They instituted regulations capping mortgages at a maximum of 105 years. In 2018, they tightened it further, forcing mandatory principal paydowns. They had to use the power of the state to force citizens to actually pay off their debts, because the natural gravity of the market was pulling them toward infinite leverage. This is the hidden endpoint of the housing wealth myth. When a society treats shelter primarily as a financial instrument to be optimized rather than a place to live, the math inevitably leads to multi-generational extraction. But if the math is this dangerous and the debt is this predatory, why do the wealthiest people in America still aggressively buy real estate? Why do they hold on to massive properties instead of just keeping their money in the stock market? Because they know something the middle class does not. They know that a house is not just an asset. It is a fortress. The courtroom in Miami is bright, bathed in harsh afternoon sunlight. It is 2018. A highly successful surgeon is sitting at the defense table. His hands are resting on the polished wood. His face is completely calm. He is facing a catastrophic medical malpractice lawsuit. The judgment against him is massive. It is enough to wipe out his bank accounts, liquidate his stock portfolio, and destroy his entire financial existence. The plaintiff's lawyers are aggressive. They want everything he has. But the surgeon is not sweating it. Because 3 years ago, he took $5 million of his liquid wealth and used it to buy a massive, sprawling estate in Palm Beach in cash. He paid off the property entirely. The plaintiff's lawyers know about the house. They know he has $5 million locked inside the equity of that property. And they also know they can never, ever touch it. If you have $1 million sitting in an S&P 500 index fund and you are sued, go bankrupt, or face a catastrophic judgment, a judge can order that account liquidated. Your digital wealth can be seized. But a paid-off mortgage in certain jurisdictions operates under an entirely different set of physical laws. States like Florida and Texas have a legal doctrine called the unlimited homestead exemption. If you own a primary residence and you meet the residency requirements, usually living there for at least 40 months and keeping the property under a certain acreage limit, the equity in that home is granted legal invincibility. Creditors cannot touch it. A bankruptcy judge cannot force you to sell it. The person suing you can stare at the $5 million mansion, knowing exactly where your wealth is hidden, and the law explicitly forbids them from extracting a single penny of it. The wealthy do not pay off their massive estates because they want to save 5% on interest payments. They do not do it because it beats the stock market. They do it because a paid-off home in a homestead state is the ultimate legal vault. It is a physical asset that the system is not allowed to break. It transforms financial capital into untouchable sanctuary. This is the true nature of housing wealth. The rules change depending on how much capital you have and what you are trying to hide. When you put all the pieces together, when you strip away the cultural romanticism of a white picket fence, when you see the 1930s banking bailouts, the 1980s tax accidents, the Swedish century loans, and the Florida legal fortresses, you begin to feel a lingering, heavy discomfort. You realize that the 30-year mortgage is not a tool designed for your liberation. It is a perfectly engineered, heavily subsidized mechanism of behavioral control. We are placed on a treadmill at the age of 30. We are handed a piece of paper that promises us wealth as long as we continue to work, continue to pay, and continue to pour capital into a decaying physical structure. We accept the illiquidity. We accept the risk. We accept the decades of interest payments to a banking sector that would collapse without our participation. And we do it all with a smile, because the tax code creates a temporary illusion that we are winning. Tomorrow morning, millions of people will wake up in their homes. They will look at the Zestimate on their phones. They will see the green arrow pointing up. They will feel a sense of pride. They will go to jobs they tolerate. To earn money they will instantly transfer to an institution they will never see. They will believe they are building a legacy. But stand in the quiet of an empty house at night. Listen to the hum of the refrigerator. Listen to the wind against the rotting roof shingles. And you can feel it. The heavy, inescapable weight of the architecture. The system didn't trick us. It just built a cage so comfortable and so perfectly aligned with our deepest fears of instability that we willingly locked the door ourselves. And the banks? They are just holding the keys, waiting for the first of the month.